Whether you're buying multifamily properties yourself or whether you're investing with other people, there are probably two things that you want to know. You want to know how do you find multifamily deals, and you want to know how to underwrite those deals. So in this video, if you're getting it via our newsletter, you just found it on the internet, what we're going to cover is how to underwrite multifamily deals in the most straightforward way. And it's very important that it's straightforward, and we'll get into that going forward in a little bit of details. But first, we need a deal. So where do you go to find deals? I'll even share my screen with you in 2 seconds. So if you're in the multifamily space, you've probably heard of LoopNet. Okay, it's an online website where you can go to find deals. Now, what I would say about LoopNet is that's not where the best deals are going to be found. Probably not, and probably most of them aren't the greatest in the world, but I'm sure there's some that are pretty good on LoopNet. Where you go to find really good deals is build relationships with brokers. You need to have access to the brokers. A lot of times these deals are trading before market. You won't even know that they traded, or you won't even know that they're for sale until they've traded. You might not even see that they traded, right? And sometimes in the world of this transaction, there's a lot of haze or cover within this field or in this investment space, which provides opportunity for the investors there. But that's beside the point. We need a deal to underwrite. So the easiest way to go and find a deal to underwrite is to get on LoopNet and look at wherever you want to go. So in our case, we're going to go to Toledo, Ohio. Why? Because we're from Toledo, Ohio, or this region. This region is also very, very popular at the moment with out-of-state buyers, probably because they see that it's cheaper than their market. And so they think, oh, well, this is, you can do more here, which maybe yes, maybe no. Irregardless. So we look up Toledo, Ohio. We set our filters. We want to find multifamily properties only. We don't want to get too specific because then we start weeding out properties that maybe we want to look at or just kind of get a perspective on. And sometimes the filters don't really work super good in LoopNet. So if we look right now, there's only a handful of properties for sale. It looks like there's 7 total properties or six total properties for sale. 3 years ago, 4 years ago, there would have been a lot more, but right now, the way the market is, it's very tight, but we can work with this, right? So what are we looking for? Well, the way we do underwriting, we don't look for 2 units. We don't look for 4 units. The reason we don't want small properties like that is risk, okay? If one person moves out in this 2 unit, you're at 50% occupied, okay? If one person just doesn't pay you, you're at 50% occupied. At this 4 unit, if one person doesn't pay you, you're at 75% occupied, okay? And there's this chunkiness or this unevenness of cash flows that make it a little bit harder to manage, right? You can't account for a water heater going out. Yeah, it's $1,000. Maybe you're, doing the math to kind of spread it out, but it gets hard. If you went to college and you've had to take a statistics class, they talk about 30 being where statistics start to work. And it's like, wow, statistics is actually a real thing because we start to see at 30 plus units, you start to smooth out those expenses. So out of all of these, the most appealing would really be this 39 unit property. Now, that's just because the number one most important thing is the door count. The second most important thing, or probably honestly the most important thing, is location. The second most important thing is the door count. But I don't know anything about these properties. I don't know their locations. This is really just off the cuff, but I'm trying to show in real time how we would do underwriting or how I would do underwriting if I was looking at a deal. So let me try and switch my screen here. We're going to just pick one of these deals and then we're going to transfer and start, piecing through it, right? So let me switch to our spreadsheet. Share that with you. And now you look at the spreadsheet that I have here and you're like, man, this is super basic, right? These numbers these numbers here will fill in. They're not accurate to this property at the moment, but we will fill those in as we go forward. But you look at it and you're like, man, this is a super basic spreadsheet. And the reason that that's important is because a lot of times people become spreadsheet warriors and they start overcomplicating the heck out of what they're doing. Okay. If you can't underwrite a property on the back of a napkin, especially in multifamily, the odds of it being a good deal are low. Okay. And you can overmath your way into convincing yourself that it's a good deal. So, a lot of the first deals that we actually bought, this is how we did the math on them. Today we do a little bit more advanced, okay? But it still runs the same concept here, okay? We'll put a pro forma in our underwriting today, and all pro forma is tells us estimates, guess, which I don't know how accurate that is all the time, but a guess is here's what's going to happen over time as we hold on to the property. But really, the reason that this is the best is because it tells you what it's going to do today with current rents. And if you want to experiment, play around, it's very clear. There's not a bunch of extra stuff for you to muddle up. And I could be like, Stephen, I don't trust this, yada, yada, yada. You could say you're simplifying it too much. But what if I told you that Warren Buffett doesn't even use Excel? The greatest investor to have ever lived doesn't use Excel, right? Because if you have to get into 7 different tabs on an Excel spreadsheet to name why this investment's good, that's bad. If you can't say this apartment complex here is good and explain it in 3 minutes to a fifth grader, it's probably not a deal you want to do. Okay. So let's go forward and figure this one out. I literally picked it up. If you're doing this deal or if you're looking for a deal and trying to underwrite a deal, here's what you do. You go to LoopNet, you want some practice, you find a property that you like. Okay. You could scroll down. I'll even click on one. Here, I'll show you. So we're on LoopNet. We want to take a look at a deal. Let's take a look at this deal from, and I got to switch the screen again. Here we go. Let's take a look at this deal. This is from Matthews. They say it's an 8.75 cap. Cap rate is just if you paid 100% cash for the property, that's what you get. You look down here, it'll tell you investment highlights, so on and so forth. You can scroll through, and they might have a couple pictures. They give you, here's subject property, here's all the things around it. But then they'll have this like offering memorandum link. If they're good, they're going to have that. So you click on that, and it'll give you, or it should give you, most of the information that you need. Now, we're not going to go through this one. I haven't even looked at this one. I don't know if that's good or not, a good investment or not a good investment. Let me present something else. So let's go back to this. This is our underwriting sheet. Off on another screen over here, I have the OM that I just showed you, not from that property, but from this property that I just picked at random. And we're going to go through and we're going to look for information. So what is one piece of information that we want? We want to know the number of units. Well, this specific property here that we're looking at has 28 units. So we can go fill that in. That's 28 units. What are the rents? Well, we scroll through, we can find the rents. If they make it easy on you, they'll give you the average rent. What you're looking for is I have X number of units multiplied by the average rent multiplied by an occupancy number. Okay. So looking through this, it tells me that they have 2 different sizes of units. You have 1 bedrooms and 2 bedrooms. Now you could break those out separately and all that type of stuff, but for simplicity's sake, you don't need to get that complicated. Okay. What is the average rent here? They've got a couple of units at 900 and 800. You got a lot at 660. 20. Okay, so they say there's 24 units. I'll do right in front of you. 24 units at 690. have 4 units. 4 units at 995. So let's format this correctly. There we go. And then do this times that. This 995 times 4. And then we can sum these numbers up. So if you collected all of the rent every month, you collect $20,540 according to their footnote here that says that's what their current rent roll is. Okay. So if we average that, they say there's 28 total units, and $733 is their average rent. And we can actually take the ask price down to 0 because we haven't figured out what we're going to bid for it yet, right? So far we have 28 units up here. We have $733 as the average rent. What's our debt cost? Debt cost is your interest rate. So right now, interest rates in 2025, it's May 13th, are about 7.25 if you're going to go to the bank and it's your first time. They might, on a deal like this, if you're going to a local bank or credit union or something like that, they're going to probably quote you an amortization of 25 years or 20 years, ask for 25. You could go and maybe get something called agency financing on a deal like this, and then you get a longer amortization table. But just to make things simple, in our case, we're going to say that the interest rate, we can get a loan, and the interest rate is 7.25. It's 25-year amortization. Amortization is how much you split, break it out over time, or pay it off over time, I should say. It's kind of like a mortgage calculator that we have right here. Okay, so just to recap on how I did that, we have 24 units that are paying $690 a month. We have 4 units that are paying $995 a month. We multiply that, 995 times 4 and 24 times 690. That gives us 1656 or 560, 16560 and 3980. Add those together, our total revenue per month, if we collected it with nobody missing a payment, no turnovers, no move in, move outs, we collect $20,540 in a year, not assuming rent increases. That's just what it is today. Okay, so we do a little bit more, investigating on what they're saying. They're saying that there's a 5% vacancy rate. So what that means is that on the move-ins, move-outs, the people that don't pay, because there will be people that don't pay, they're collecting 95% of that $20,500 number per month. So we can go and put that in here with the occupancy rate. Right here, we can go 95%. Do we know it's 95%? I don't know. I haven't seen the property in person. I don't really know where it's at. I don't know very much about it, but we're just doing the numbers side of things. What do the numbers say at the moment, according to the information that they gave us? And then later we'll check, okay? So occupancy rates, 95%. Cash funding. This is how much money you're going to put down. Right now, typically, you're going to need to put down 25 to 30%. So that means your loan to value, how much of the purchase price you can borrow from the bank, is about 75 to 70%, 70 to 75% right now in this market. So that means cash funding, we're going to put down 25%. Okay. You're probably going to need a little bit more because you're going to need some reserve. But to make things simple, we'll put 25% down right here. Maintenance. Now, when we go read through the OM, they said that they have a brand new roof. That's a big deal that there's a brand new roof. It's good for insurance. It's good for you. You don't have to worry about leaks and stuff like that because that does happen. And then they give some more information on capital improvements that have, happened, so on and so forth. But this is an older property. I don't know exactly when it was built. It doesn't really say. If it does, I missed it. So let's just assume it was built in the 70s. Okay. So 1970s properties generally usually considered a C class property, an older property. So your maintenance number is going to be a little bit higher. So what we would do is say, all right, 12% of our total revenue that we collect every month is going to go towards maintenance. Maybe that's just reserves, or maybe it's turnover expenses, or maybe it's drywall repair, replacing carpet, or mowing grass, or so on and so forth. So 12%. Management fee, you're probably going to need more than three. You're probably going to need a 5% shit. You might need more. Let's say 7%. Okay. On a one-off random property that's 28 units. Uh, yeah, 28 units. The bigger you get, the more efficient this management number could be. But to say this is your first property, let's say 7% is what you're going to get it managed for if you're getting going. So what's that leave us with? Full priced, borrowed amount, cash needed, interest, total period, taxes. Let's see if they give us an asking price. They say it's for sale for 1.3 million. Put another zero in there. So what's that come out to? That's a pretty high cap rate. Okay. So next things you need to take into consideration, your property taxes. What are your property taxes going to be? What it is today is not what it will be when you buy it. What do I mean by this? Typically, property taxes don't go up as much, especially if you held onto the property for a long time, as they probably should be. So when you buy the property, the county or the city or whoever is going to reset your property taxes to reflect the new change in value or the traded price and value. Okay. This is highly specific on where you are, and it's typically going to be a percentage of the purchase price. If you're in Ohio, we use millage rates. In different areas of the country, different rates are used. Okay. Ohio is very expensive, and so is Lucas County, where this is very expensive in property taxes. You're probably paying around 2.3% a year. So an easy way to figure out what your property taxes would be is we can say equals, let's say minus. That's because we want it to be negative, so it subtracts. Take this times, and then figure out what percentage of the total purchase price or traded price the county kind of assesses things on. So here it's probably 2.3%. This is kind of not super exact. This is just off of basic knowledge. I think it's a little bit lower here. I can't be for sure, but I know it's pretty close to this number. Okay. Insurance. Insurance is another thing. You're going to have insurance. An older property is going to probably be more expensive than a newer property. The fact that there's a roof on this means that your insurance is probably going to be lower, or you're going to get better coverage. Because sometimes, insurance has just been really, really tough right now. I don't think you could insure this for 11.7 a year. I think you're more like 1 point. I think you're more like probably 17,000 a year at least on this. Maintenance 29,000. That's probably pretty accurate. Management probably there. So when we add all this stuff together, you have 92,732. That's your total expenses that it's going to cost you before debt every year to manage it. So basically, you're spending $100,000 a year just to manage and operate this. And may say, Stephen, what if I manage this myself? I can get rid of that number. No, you can't get rid of that number. Why? Two reasons. Reason number one, are you going to work for free? If you're going to work for free, then you might as well not do this and just get a second job, right? Like, let's think this through. You've got to get paid for the time that you put into it, whether it's you getting paid or somebody that you hire, right? So you have to charge the management fee. I've had people come and tell me before, hey, I don't want to charge this management fee because I'm just going to manage it myself. What about this maintenance? I could just do the maintenance myself and that would reduce it. Are you going to work for free? There are going to be times that you can't do that, right? So you're asking for trouble if you don't put that in there. You're also asking for trouble if you don't get good insurance. You could get cheaper insurance until one of the units burns, okay? Or until something goes down. And something will go down at some point in time if you ever have enough units, right? So make sure that you're not underinsuring your property. Make sure that you're reassessing the value of the taxes because they will go up. This probably isn't as important if you're in states like Florida, but it's very important if you're in states like Ohio. I think Indiana is significantly lower. So taxes make up a little bit different or a little bit less in those states. So that's your total cost just to operate the property, okay? If you take the total revenue that you made, which in this case here is where our revenue is $233 a year, okay? You subtract this number right here, and I'll do that for you. If we take this minus, which we should actually put a plus because it's already negative, we get 141, okay? This is called net operating income, NOI. Okay, net operating income is what you would get paid if you had no debt on the property. But most people get into real estate because of the leverage. The leverage, which is borrowing money, enhances your returns, okay, if it's positive. So you want to be able to borrow money on a property that you're buying, especially in a location like this. If you can't borrow money on a property that you're buying, you probably want to reevaluate the property. So our NOI is 141 according to the numbers here. Okay, let's get rid of that. To get to what we would actually make on our investment, we have to subtract out our annual mortgage costs or the annual debt costs. And in this case, since we already did a mortgage calculator here and we've put it together in the spreadsheet, we know what that is. So it costs you $85,000. Meaning, if we bought this for $1.3 million, we'd have to put $325,000 down. We'd borrow $970,000. Here's where I'm at. We put $325 down. We borrowed $975. 1.3 is what we paid. And then we would make $55,000 a year, which means in this scenario, if everything was good, that'd be a 17% return a year. That also means that that's a 10.8 cap. Now, if we go back to this screen and we look at this, it says 8.48. So somewhere we made a mistake or somewhere we're doing better. So let's go back to our underwriting and figure out what's going on. Why do our numbers not match? It's okay that our numbers don't match, okay, at the moment. As we look through, and then we get back to the income statement. Here's a reason. When we look at their income statement, their gross operating income versus ours, there's a difference. They're at 225, we're at 233. So we have to adjust that. The easiest way for us to adjust that is through the occupancy rate right here. We can go to 93%. It's just closer, but still not there. 92%. It gets us close enough for where we're at right now. Okay. That brings us down a little bit. Taxes, they're at 27,000. So actually we're pretty close. Insurance, we're a little higher than there, but I would take ours over theirs. Ah, and here's another area that we're wrong. If we look at their expenses are higher. Let me play with it a little bit and get it to what their number is. So this is pretty close to what their expenses are. So where we were at 12%, which is what we typically like to run, they're at 22%. Okay. That means their net operating, and they're saying their net operating income is 110. So if we take this, which is our revenue, see that? We add, there we go. We're pretty close to their net operating income. So in this scenario, to get our numbers to match what they're saying the property performed at, okay, the first time when we went to the first pass, we went with our generic numbers. What should properties operate at, right? We paid 1.3 million, borrowed 975, so almost $1 million. Cash needed was 325. That means our net is 24,000. So our cash on cash is 7.4%. Cap rate's 8.44. Okay. This is how you do underwriting. You go back and forth, and then you start asking questions. Okay. So if normally maintenance is 12% and this is at 22%, what's going on? What's the extra story there? Water, sewer, taxes, insurance, refuse, care. And you can continue to go forward and kind of piece through things and kind of tell the story of the property through the numbers. You also would want to go and actually, visit the property in person. But for, I'm looking at this expense ratio. This is pretty close. 55%, somewhere in there is typically where properties in Toledo, Ohio run with the expense ratio. So it's not totally off. The expense ratio looks relatively correct, a little tight. So it should be operating pretty well. Pretty expensive though on the maintenance side of things. I mean, you're spending 54,000 a year on 28 units in terms of maintenance. That means divided by 28. You're spending 2,000 a year, not too crazy. Yeah, I don't think I'd want to pay a 1.3 for this. What happens if we take 100 grand off of it? Cap rate's 9.45. I doubt they'd want to, pay that or sell it for that. And we keep looking through this. Takes our cash on cash to 11.45. You can kind of continue to play with numbers like this. Okay, what happens if we can get better rents? What happens if our rents go to 800? Well, rates go to 800, then the cap rate goes to 9.5, or cash on cash goes to 11. Okay, you might say, Steven, well, what happens if the rents aren't great here? What happens if you can't push rents? And we're back to 733. Okay, what other value add or opportunities are there within this possible property? Okay, well, when I look at this over here, and let me just actually show you this because it would help you, I think. So this is in their offering memorandum, their OM. They give you this. Now, I don't like that they didn't describe exactly what's going on here. I mean, it's a little hard to read. So this is A. This is their current rent roll, and I think the B is their pro forma. So if I look at the current rent roll, like 660. So I don't know if they average those out. Like, you would have to dig into detail into seeing what those are. So I would say that this is probably this B over here is probably their pro forma. That's like what it could be. Do your own thinking on what it could be. And this A is probably what they currently are at. Okay. And then they talk about all that type of stuff. Something that people often overlook is, okay, this is a 1-bedroom. What's the square footage? So 586 for a 1-bedroom, that's okay. 983 for a 2-bedroom, that's probably a pretty good size 2-bedroom. That's good. But if it was a 2-bedroom or a 1-bedroom, yeah, no. If it was a 2-bedroom, it was like 650 square feet. That's really like an extra large 1-bedroom. Not even that. That's like a normal 1-bedroom, maybe. You want to just be, I'm giving you some insight into nuances. Okay. So you just have to ask yourself now, a value add play right here. Okay. Well, if their rents, if you can actually get these rents, take a look at this: water, sewer, and then look at their miscellaneous income. I don't know what the miscellaneous income is. They say C includes pet fees, late fees, NSF, etc. Well, what if you, let me switch back to our window over here. What if you said, okay, we can do a bill back and we can charge the water, sewer, trash back to these people. So if we add that back to figure out what they're spending per year total on that water, sewer, they said 18,000. Let's just go 19,000 plus their refuse, which is 7,000 divided by 28 divided by 12. They're spending $77. That's a lot, man. $77 a unit a month on just water, sewer, trash. So what if you could get $60 for that? You keep everything the same as where it is today at 733, which that's their pro forma, by the way. This is their pro forma. Yep, that would be their pro forma. So on their pro forma, it's an 844 cap. Okay, not on existing. Your cash on cash would be 7.44. Okay. But what happens if you could get, say, you could bill them back for $60 a unit per month? And just to make it simple, so you did that, out the gate and you collected it all. Now you're at 793 on the revenue. It goes to 943. It turns to 1138. But that's something that you have to do that doesn't exist right now. That's a value add play. You're just reducing expenses like that. But yeah, 1.3 is a little rich, in my opinion, for Toledo. I don't know exactly where this is at, and it's 28 units. I mean, if it was 56 units, maybe it'd be, depending on where it's at, maybe it would be a better deal. And why do I say that? That comes from experience right there. Because 56 units is easier to operate than 28 is. It's easier to manage cash flow. It's easier to do maintenance. The distributions are more meaningful. It's easier to manage. It's, better than 28 units. It's easier to turn the units. That's a hard thing too. Like if you're turning 2 units at one time, That's 26 divided by 28. That's 93% occupied. You just lost 7% of your occupancy. And if two other dodo brains are slow at paying you in a month, while you're turning over, you're at 86% occupied or 86% effective occupancy. Well, let's go from here. We're at, and you might collect the rent, from the people. You might turn it, everything might be okay, but your cash flows are lumpy. So 1 month it'll look like this, or shoot, my cash on cash went really low, or maybe even like this. So you look at your cash on cash with 2%, and then the next month it'll go back to where it should be. So anyways, this is how you kind of go back and forth, and you look at numbers like your expense ratio. Is this correct for the area? You want to look at a lot of properties like that. Then you ask yourself, am I okay with, why is it messing with this right now? Am I okay with this right here? Am I okay with this 11% cash on cash return? Most people would say, yeah, that's great. But they won't, maybe they'll sell it to you for that. I don't know. Is 1.3 million, I believe, is what they're asking for it. Okay, are you okay with making 24,000 on a $325,000 investment? I don't know. Do I think you could operate this for less than 22% maintenance? In this formula, the way that we have it set up right there, no, because this is the expense ratio that seems pretty reasonable for the area. I think you might even be a little bit higher than that. You might be at 55. But yeah, that's generally how you do it. You take your top line, and maybe I should, to make it easier for everybody here, we can look at it this way, make it so that it's easier. Okay, you got your revenue here, take out your taxes, you take out your insurance, take out your maintenance, take out your management, your total costs, then take out your mortgages, and here's what you're left with: 24,000. That in dollar cents, so 744 cash on cash doesn't look bad. But think about this, okay? What happens if you have to remodel 2 units at 10,000 a piece? Then you only made 4,000. These are questions. I'm kind of giving you a mental stream right now, on what I'm thinking. Not saying it's a good investment, not saying it's a bad investment. Just, you haven't developed anything. You're just playing with the numbers, familiarizing yourself with it. What would I have to do to get a return that I want? What's my downside case scenario? What happens if this thing goes to 88% occupied? Okay. I don't know. And then you want to go walk the property. Okay. So we've done all this math right here. Like, once again, you might be like, Steven, this is dumb. Like, this is too simple. Okay. Well, if you can't tell the story of a property with something this simple, it's probably not a property you want to buy. Right? Here's the magic formula that everything revolves around. Right here. That's the magic formula. Revenue minus all these different expenses, taxes, insurance, maintenance, management costs. Take out your debt. Here's what your total expenses are, and here's what you're left with. That's the magic formula. Why do you want to use leverage? Because you want to enhance these returns. Somebody else is paying down the debt. I mean, your total return is going to be better than that. But okay, so that's basically how you do it. We've bought properties using literally nothing more than this formula right here, without doing a pro forma and all these different spreadsheets. Like, we've bought properties that have been killer properties, man. They've just Like they're bangers of properties doing that right there. Simple scales, fancy fails. So all these people that they want to be spreadsheet warriors, go ahead and do that. That's fine. You want all these different values, or they might say, well, if you have a bunch more units, then you've got to take into all this other consideration. It's like, dude, a bunch more units, it gets easier. 100 units. If this was 100 units versus 28, dude, way easier. Okay. Because you have more areas to smooth things out and pick things up, and dollars go further in absolute terms on bigger units, right? So, yeah. Anyways, here, take a look at this, figure out how we did this. Go ahead and run through the numbers again. I can maybe show you this again if you want to just kind of view this. This is just an example. Once again, not saying this is good or not good to buy. Just thinking about that stuff, this is hard to work with. This is really hard to work with because it doesn't really have the averages. And then like this stuff is just, that's your pro forma. So do I think your 24 units could run at 690? Those are one bedrooms, I'm assuming. These four 2 bedrooms. If it's in a good area, it should rent for about $100 more. Those are pretty aggressive for, I mean, that's shoot, maybe for the 2 bedrooms, maybe. So I think you could get more for that. I don't know. You don't know without walking the property, seeing the property, and doing more. But long story short, wanted to get on here and give you a hands-on view of just how to do some basic underwriting. Really it comes down to this formula. We're taking the revenue, subtract out taxes, subtract out insurance, take out your maintenance, take out your management. Do not count one of those line items because you're trying to make a deal work. There's your total expenses. Take your mortgage costs out. That's your total expenses. That's what you're left with. Take that, divided by this 325, which is the cash you invested. That's your cash on cash right there. Last note, this cash needed, that's what you would need to be 25% down. Okay. You're going to need a reserve. You're probably going to need another 50,000 on top of that. So really, probably something like 30% all in cash. And then see what it does there. So now you're at 390. Shoot, you might be more. 390, there's your cash on cash, there's your cap rate. Should anyways, that's how it works. Happy to answer any questions. Hopefully you found this video helpful. Our actual models are a little bit more in depth. I haven't actually played with this in a while. So off the cuff, wanted to pick something up, thought it'd be useful. I don't know anything about this deal. I don't know if it's good or bad. I don't really know where it is or anything like that. But wanted to show you kind of behind the curtains how to do it, very basic, but really just how it works. Any questions, feel free to ask. Thanks.